Have you ever imagined controlling a seven-figure trading account with just a modest sum of your own money? It sounds like the kind of hype you see in spammy ads, but today we're doing the opposite of hype. We are talking realistic, transparent strategy. In this video, I'm going to show you how serious traders can leverage proprietary trading firms, or already known as prop firms, to access 6 to 7-figure capital and achieve consistent returns using a hedge-based approach. Not get-rich-quick gimmicks here, just a calm, truth-driven breakdown of how this works in practice. First, let me frame what we are about to cover. By the end of this video, you'll understand how prop firms operate, why most traders fail with them, and how you can be different. We'll compare a few trader archetypes, from someone with just a few $100 to someone managing $1 million or more portfolio. I'll walk you through a conservative numbers blueprint with actual dollars figures, nothing pie in the sky. We'll explain hedging, the key to making this strategy risk managed in plain English. Then we'll hit constraints and reality checks, because there are some and you need to know them. I'll share a business analogy to put things in perspective and even some social proof, real examples of results. We'll do a 3-account case walkthrough to show how it plays out step by step. Finally, we'll clarify who this approach is right for and who should avoid it, before wrapping up with a quick recap and a soft call to action for further learning. All right, first things first. What exactly is a prop firm and how do they work? If you're already prop firm aware, bear with me. A quick refresher will set the stage. A proprietary trading firm is a company that funds traders with its own capital. In retail trading, this usually means you pay a fee to take a trading challenge, and if you pass the challenge, they'll fund you with a larger account to trade. You keep a percentage of the profit split, and the firm keeps the reset as their reward for providing capital. Now, on paper, that sounds great. Instead of needing, say, $100,000 of your own money to trade, you could pay maybe $500 for a challenge and potentially get a $100K funded account with, say, an 80% profit split on that account. If you make $10,000 profit on that account, you keep 8,000 rewards with the 80-20 split and the firm getting 2,000 on its end. Everyone wins, right? Well, not so fast. The reality of these retail prop firms is a bit more complicated and frankly cynical. Here's the dirty truth. Prop firms make most of their money from traders failing the challenges, not from traders succeeding. You might already know that. The upfront challenge fees and sometimes monthly data or seed fees for funded traders are the prop firm's bread and butter. In fact, retail prop firms generate most of their income from one-off challenge fees and subscriptions. These firms could pay out 80-90% of profits to traders and still be hugely profitable themselves, because the majority of traders never see a dime of profit. The industry stats bear this out. Only about 5 to 10% of traders pass the evaluations, and just 7% of them ever receive a payout. The rest fail the challenge or lose the funded account quickly, and those failed challenge fees fund the payouts for the few winners. It's basically an insurance model. Many pay in, few get paid out. Let me underline this with a quick example. Suppose a prop firm charges $500 for a 100K account challenge. 100 traders attempt it, that's $50,000 in fees collected for the prop firm. If only 5% pass, that's 5 traders getting funded. Even if each of those 5 traders eventually makes some profit, and you should remind the 7% of them that will, the firm already banked $50,000 minus whatever small refunds and the coming profit share they will give out. The firm can easily afford to pay the successful traders from the pot of fees collected from the 95 who failed. As one analysis put it, prop firm payouts are essentially funded by the 95% of failed challenges. Now, I'm not saying this to trash prop firms. Some are reputable and really serious, but you must understand their incentives. A lot of flashy prop firms out there want you to keep buying challenges and resetting after failures. It's a volume business for them. They advertise big funding amounts and quick payouts, but they tighten the rules to ensure most people slip up. Strict daily drawdowns, overall loss limits, specific trading days required. These are all pressure points that cause many traders to fail the tests. So lesson number 1, prop firms are not charities handing out money to traders. They are businesses, and in the retail prop space, their business model is often more like a casino than a traditional investment partnership. The house, prop firm, has the edge. They profit even if you don't. Knowing this, our goal as traders is to flip the script, to utilize prop firms' capital while protecting ourselves from being just another donor to the house. And that's where the right strategy, specifically a hedge-based strategy, comes in. We'll speak more about that soon. Before we get into strategies, let's quickly touch on profit splits and conditions, because those factor into our game plan. Most prop firms offer profit splits of about 80-20 to start. So you keep 80% of the profits. Some newer firms or special programs boost 90 to 10 or even 100% for the traders in certain cases, but often with strings attached or after proving consistency. Payout schedules can vary. Some allow withdrawals after a few weeks, others monthly, some even weekly or daily for a few firms. But frequency doesn't matter if you never get to a payout. The key is getting a funded account and staying funded long enough to withdraw profits, which again, only a small fraction manage. Only 7% get a payout at all, as I mentioned previously. So the takeaway in simple terms, prop trading firms give you a shot at big capital, but the odds are intentionally stacked against you if you approach it with the typical one and done mindset. To beat those odds, you need to come with a smarter plan than the average jaw clicking buy challenge and praying. Before we dive into that smarter plan, let's set the stage with a comparison of 3 typical trader archetypes. See where you might fit, and it will clarify why a hedge-based, business-like approach is the way to go. Picture 3 traders standing at the door of a prop firm challenge. We'll call them Alice, Bob, and Charlie, just to personalize it a bit. Their situations are very different. Alice has maybe $300 to her name, or that she's willing to invest in her trading dream. She's the shoestring trader. She sees that for around $300, she can enter a challenge for 50K or maybe 25K account. Prop firm fees vary. Smaller account challenges cost a few hundred. Alice basically has one bullet. If she fails the challenge, that money is gone. She doesn't have much left to try again immediately. Unfortunately, Alice's odds are poor. Remember, perhaps 90-95% of challenge takers fail. So if Alice just jumps in without a solid plan, she's likely to become part of that statistic. Many Alices treat prop firm challenges like a lottery ticket, a high-risk bet hoping for a lucky break. And the prop firm is happy to take her $300 in exchange for a 5% or less chance she actually succeeds. It's harsh, but that's the reality. Bob has $100,000 of his own capital, or access to it. He's a more established trader or investor. Bob has a choice. He could trade that 100K in his personal account, or he could use prop firms to leverage that into maybe 500K, 1 million, or more in trading capital. Bob is not cash strapped. He can afford multiple challenge attempts if needed, and crucially, he can afford to protect each attempt with hedging or other techniques. We'll explain hedging soon. If Bob trades his own 100K account and makes, say, 20% in a year, that's $20,000 profit. Not bad, but Bob's full 100K was at risk in the market, and he had to be very careful. 20% is a decent return for moderate risk. Alternatively, Bob could deploy perhaps a fraction of that 100K, maybe $20,000, $30,000 into taking a securing prop firm accounts, turning that into, say, 500K of prop firm portfolio, just as an example, to trade with. With 500K prop capital, even a modest 10% profit would be $50,000, and Bob's cut, say, 80% would be $40,000. That could be done in several months with controlled risk, theoretically. So Bob's looking at possibly doubling the returns without using its own money, while actually risking far less of his personal cash, since only challenge fees and some hedge costs are at risk, not the whole 100K. Bob's archetype is the pragmatic investor. He has capital, but he wants to maximize ROI and safety by leveraging other people's money. Charlie is aiming for the max scale. He's thinking in 1 million, 2 million range of prop firm capital. Charlie might be an experienced trader or a pure investor backing traders who says, I want to build a portfolio of prop accounts to manage to generate serious returns. Charlie knows most firms cap a single account at a certain size. For example, one top firm's biggest single account is 200K, and they might cap you around 400K or so total unless you scale up or open multiple entities. But Charlie also knows you can often open multiple accounts or use multiple prop firms. For instance, one could theoretically manage 10 accounts of 200K each to have 2 million total. There are traders who do this by spreading across firms. Charlie is ready to allocate some serious upfront money to achieve this, perhaps tens of thousands, but he expects a structured plan for it. Charlie's not gambling. He wants a system. He's treating it like building a business venture. Charlie would be thrilled with, say, $10,000 a month steady, which is 120K per year, because it's high ROI on the investment. Charlie's archetype is the strategic fund builder, possibly working with a team or a service to do it systematically. He might even be the kind of client who comes to something like XO Capital to implement the plan, but more of that later. Now, why did I lay out these 3 scenarios? Because I want you to consider where you fall on the spectrum. Most likely you're somewhere between Alice and Bob. Maybe you have a few thousands or 10 of thousands you could allocate to this venture, but not hundreds of thousands. The good news is you don't need to be super rich to start. The strategy we'll discuss can, with careful scaling, turn a relatively small working capital into control a much larger pool. However, the less you start with, the more you have to acknowledge the risk of ruin. If you only can fund one try, one failure wipes you out. That's why I generally advise against the Alice approach of scrapping together a single fee and rolling the dice. Unless that $300 is truly throwaway money for you, it's better to save up a bit more or practice until you have a bigger hedge. For those closer to Bob or even Charlie, your advantage is the ability to engineer a high profitability of success. With sufficient working capital, you can employ strategies like hedging across multiple accounts that dramatically increase your chance of getting funded accounts and keeping them. Essentially, you can lower your risk and smooth out outcomes by investing in the process, just like a business might invest in equipment or insurance to ensure stable operations. I want to stress something here. Prop firm trading with a hedge strategy is not a gamble. It's a calculated business approach. If you treat it as such, you shift from being the casino patron to almost being the house, or at least to having positive expectancy. In the next section, I lay out some actual numbers, a blueprint, to show you what I mean by conservative realistic expectations. We'll use Charlie's target, around 1 million, 2 million in funding, as our high-hand scenario, but I'll show how that scales down if you're more like Bob or even a well-prepared Alice. Let's get down to the numbers of this. I call these the conservative blueprint because these aren't pie-in-the-sky best case numbers. They're moderate targets meant to be achievable without errors. By planning with conservative figures, we leave room for error and keep ourselves grounded. Here's the blueprint broken down. We'll assume about 2 million in total prop capital is the upper goal. For example, 10 accounts of 200K each. This is considered a realistic cap with top prop firms or a combination of prop firms. Some firms might cap lower or higher, but 2 million is a good round figure for a full scale of one trader. Approximately $55,000. This is the total personal capital you'd need to deploy over time to reach that 2 million funded level with a high probability of success. That figure covers challenge fees, hedge costs, retries, basically all the expenses you need to manage the accounts. About 100,000 net to you. This is what you could expect to earn after all prop firm splits and fees in the first year following the strategy. It factors in a cautious trading approach on those funded accounts, not shooting for moonshots, just consistent gains and withdrawing profits regularly. So the big picture is, with about 55,000 invested in the process, you can realistically put about 100K profit per year once fully ramped up without compounding. That's more than doubling your money in a year in pure profit. These figures are way above typical stock market or real estate returns, but they are achievable because we're operating in a high leverage trading environment with controlled risk. Now, controlled risk is doing a lot of work in that sentence. We need to talk about how we control the risk, which brings us to the hedging strategy that has been hinted at. This is the crux of making those numbers possible without relying on pure trading genius or luck. So let's break down hedging clearly. So what is this hedging strategy that I keep mentioning? And why is it a game changer for using prop firms effectively? Don't worry, this isn't about complicated option strategies or anything like that. In the prop firm context, hedging basically means taking simultaneous opposite trades such that one offsets or guarantees the success of the other. Let me put it in a very simple scenario. If you have one account, account A, you will have another account, account B, that takes the opposite trade. For an example, with A and B, we could have Euro USD buy on account A and Euro USD sell on account B. So inevitably, one account will hit the profit target while the other is taking a loss, or vice versa. Now, a few important points about hedging this way. You generally do this across separate accounts using a broker account rather than two challenges. If you put two accounts on the same prop firm and trade them as perfect opposites, the firm might notice, if they care to check, that you're gaming the system, and many prop firms explicitly ban this practice if they detect it. They consider it a form of cheating or exploiting the model, and they can void your account if caught. We'll talk more about this in the constraint section, but just know that part of doing this smartly is being discreet and or using different firms to hedge each other, firm X versus firm Y, so that each firm only sees one side of your trading. There are also services and softwares that helps execute this, but if you're doing it manually, you can literally place opposite trades on two MT4 accounts side by side. Hedging doesn't mean zero risk or effort. It's not a magic wand. Things can still go wrong. For example, if you don't execute simultaneously, or if one account hits a daily drawdown limit before the other hits profit targets, you might lose both. In the scenario, you are using two prop firms challenges. That's why we recommend using a broker account for the account B. Also, prop firms have profit targets, and sometimes they have restricted daily drawdown, or it can be trading drawdown for futures prop firm. Simply placing opposite trades and waiting might not guarantee one hits the target in time unless the market moves sufficiently. So usually the approach might involve taking some calculated trades rather than brute force mirror trades to make sure at least one account hits the target. So there's a bit of finesse in how you manage the trades. It's not as simple as betting your entire account on one way versus the other, because if the move is slow or choppy, It might never hit your target, and even doing this is a flag for the prop firms. But conceptually, you are using one account as an insurance policy for the other. About cost of hedging, as we listed, you might spend about 20 per phase in this method. That means if everything goes to plan, you spent about $2,000 to pass phase one. Another $2,000 will happen for phase two, so total you're about $4,000 sunk costs for passing the challenge. You might say we've burned that amount, yes, but however, at the end, you have a funded account. Importantly, you have protected your own capital for trading losses. You effectively paid a fixed cost to avoid the risk of trading losses. Think of it this way. Without hedging, if you try your challenge with one account, you might trade cautiously to avoid failing, but then you might not reach the profit target. Or you trade aggressively to hit the target, but then you risk hitting the loss limit. It's a dilemma. With hedging, you remove that dilemma. You can trade as aggressively as needed because you have an opposite position buffering you. One will likely bust, yes, but the other will likely succeed. It turns the challenge from a high-skill, high-risk endeavor into more of a statistical near certainty that you can buy a funded account if you're willing to pay for a couple of losses. We basically trade money for probability. Now, I want to clarify. Is this how trading is supposed to work? From the prop firm's perspective, no, they don't like this. They technically just want traders to spend money on their challenge fees, not people trying to make profits from their system. From our perspective, we're not here to impress a prop firm with trading genius. We're here to get that funded account and use it to make money with minimal personal risk. I'm not advocating doing anything against any legal rules, but do check each firm's terms. Many have clauses against multiple accounts in concert or a strategy that guarantees outcome, and so on. In practice, traders who hedge often do it either under the radar or in ways that aren't easily detected. For instance, using two different firms or spacing the trades out a bit so they're not a perfect mirror every second. Some traders hedge by trading correlated assets or using different lot sizes to make it less obvious. There are nuances to avoid detection, and it's an involving cat and mouse game. Be aware, if you are blatant, you can get in trouble. Prop firms will ban and confiscate payouts if they catch clear-cut hedging strategy. You have to be smart about it. Don't let that scare you off. It's just about being professional. This is one reason why some people team up with a service like Exo Capital that has a refined process for hedging legally and effectively. I modestly say we have our hedge engine, which is basically an expert advisor algorithm that executes these hedging strategies with precision and within whatever guidelines we need to follow. It's been deployed across a lot of accounts successfully. In fact, as of recently, our hedge engine was running across over 5 million in FTMO portfolio, which shows it can be scaled, but I digress. So to sum up hedging, it's how you tilt the odds massively in your favor. Instead of a 5-10% chance using one account, you might turn it into a 19% chance to get funded by using some working capital. You're essentially paying for a high probability outcome rather than gambling on a low probability one. This transforms prop trading from speculation to a more controlled operation. One more thing to mention is hedging during funded trading. Everything I described was about getting the account, passing the test, but you can also using hedging principles once funded. For example, if you have multiple funded accounts, you might trade them in a way that they hedge each other to ensure you lock in some profits. Or you may hedge a funded account with a personal account or a different broker to protect against drawdown. The core idea is risk spreading and insurance. We won't go into advanced moves like that here, but frankly, if you have several funded accounts, you can simply rotate trades among them. Not all eggs in one basket at one time. That's a simpler form of hedging. Not every account is active at the same time, so one blowing up doesn't wreck your whole portfolio. We'll touch on these in the multiple account walkthrough. All right, now you understand the secret sauce that underpins our numbers. Hedging gets you the funded accounts reliably and keeps your risk limited to a known cost, the hedge cost. It takes the wild uncertainty out of the challenge phase. But before we all celebrate, I want to bring a dose of reality. What are the constraints and downsides of this approach? Let's head into that, because I want you to know the full truth, not just the upside. Time to get real about the limitations, constraints, and potential pitfalls of this whole prop firm hedging game. As excited as I am about the opportunities here, I'm not going to sugarcoat the challenges. A strategy that sounds like guaranteed funding obviously has some catches, otherwise everyone would be doing it openly. First point, firm rules and bans. As we hinted, most prop firms forbid coordinated hedging, especially across accounts in the same firm. If they catch you running mirror trades to guarantee a pass, they reserve the right to terminate your account, cancel payouts, and ban you. Some firms share data or use broker tricks to see if accounts have opposite trade fingerprints. Now, practically, many retail firms don't have sophisticated detection unless you make it obvious or withdraw huge amounts suspiciously. But the risk is here. So you must operate either across different firms or use very careful execution. For example, you might do firm A vs firm B for the challenge phases. That's usually safer because the firms aren't sharing trade data. The point is, you can't be sloppy. This strategy thrives in a bit of a gray area of what prop firms allow. It's not illegal, you're not breaking laws, but it might be against the firm's terms of service. So consider this approach an open secret, use it wisely, and don't brag about it in the firm's Discord or something. Upfront cost and cash flows are our second point. The blueprint said $55,000 required working capital. That's not pocket change. You need to have a plan for how to deploy that. It's not all spent in one day. You might spend it gradually over 24 months, a few thousand on initial challenges, get some funded, then reinvest payouts into more accounts, etc. But the reality is you may have to float the cost of multiple challenges at once to really speed things up. If you're more limited in capital, you can still apply the concept, but maybe on a smaller scale, which means slower scaling. There is a trade-off. More money lets you secure more accounts faster. Like Charlie in our previous example might just go and start 10 challenges hedged in pairs, whereas someone with less might do one or two at a time, like Bob might do two at a time, for example. Use profits to fund the next two, and so on. Patience is key if you're not as capitalized. Don't overextend. Only use capital you can afford to tie up for a while, because prop firms don't pay you back until you succeed. And then some only refund fees on first payout. Our third point is operational complexity. Running multiple accounts, especially across multiple prop firms, is not trivial. It can be a part-time job in itself. You have to track different logins, ensure trades are properly mirrored or split, keep an eye on all accounts metrics, daily drawdown, profit targets, trading days, etc. Mistakes can happen. For instance, you might accidentally put the same trade on both accounts instead of opposites. Oops, now both accounts move the same way and could both fail. Or you might miss closing a trade on the losing side in time, causing the winning side to overshoot. If you're doing this manually, you need to be organized and possibly use tools like softwares, which can be programmed to make the work for you. If you work with a team or a service, they might handle this for you. For example, at Exo Capital, we offer FTMO management services where everything is keys in the end for you. But a solo trader needs to be aware this strategy can be a handful logistically. It's manageable. You can do it yourself. People do it. Just don't think it's completely hands-off if you manage operations. The fourth point is psychological factors. Just because you have a surefire mechanism to pass challenges doesn't remove all stress. Trading, even with a hedge, can be nerve-wracking. You'll see one account in the red deeply, the losing hedge, and the other in the positive. You might be tempted to interfere or second-guess the plan, or once funded, you might trade too aggressively, thinking you're invincible, or not aggressively enough, becoming too cautious and not hit payout thresholds. You still need trading discipline when it comes to taking profit, stopping, and restarting accounts. Also, a reality. Even hedging doesn't guarantee profit in the funded stage. You could pass challenges, then trade badly and lose the funded account without ever getting a payout. Yes, you could rinse and repeat, but you still have lost a bit of time. We assume in our plan that once funded, you'll trade in a sane, low-risk manner to extract that typical 5-6K payout per account cycle. That requires patience and consistency, not swinging for fences. Many traders emotionally struggle to dial back after going through challenges, which might have involved taking some big risks on one side of the hedge. So mindset matters. This isn't a get-rich-while-you-sleep scheme. You have to be mentally engaged and treat it professionally. Our fifth point in this section would be prop firm reliability. Another often overlooked constraint. Not all prop firms are created equal. Some might simply not pay you even if you succeed. There have been scams in this booming industry, firms that shut down or refuse payout if you make too much. We heavily prefer working with the most reputable established firm in the industry, which is FTMO, because we trust them and they have been in the industry since 10 years now. So part of your strategy is picking the right firms. If you go beyond one firm, choose ones that have good reviews and track records of payouts. Also, check their maximum allocation rules. For instance, one might let you have 3 accounts up to a total of 600K, another might allow 500K, etc. To reach 2 million portfolio, you might need to use a couple of firms in tandem. That's fine. Just plan it out if you're doing it alone. Market risk in hedging is our sixth point. We should note, if the market is extremely quiet or extremely volatile in weird ways, hedging outcomes can deviate. For example, imagine a month of range-bound tiny volatility. Neither of your opposite trade hits the profit target for a long time. You've lost some swap fees and some weeks. It doesn't usually happen if you take at least 1 or 2 decent trades, but it could if you just set and forget the operations. Extreme volatility, like a surprise event, could theoretically blow both accounts if, say, one hits the loss limit but then reverses and takes out the other before hitting target. Hedging greatly stacks odds in your favor, but execution matters. Finally, ethical and long-term considerations is our 7th point in this section. I just mentioned this. Some purist traders argue that if you can't pass a challenge legitimately, you shouldn't trade a funded account because you don't have the skill. I take a different view. Trading with prop firms can be seen as a business venture separate from purely showcasing skill. You're skillful in a different way, in operational strategy and risk management. There's no rule that says you must only trade one account and prove your naked skill. That's a narrative prop firms like to promote. In reality, if the goal is making money with limited risk, hedging is just smart. However, over the long term, if prop firms tighten rules or detection, you might need to adapt the strategy. We've seen some firms disallow trading the same instrument on two accounts at the same time, hard to enforce, but they try, or they monitor IP addresses, so use of VPS or different networks for each account. It's a bit of an arms race. I believe opportunities will remain, but be ready to adjust tactics as the industry evolves. Okay, that was a lot of reality check. If you're still with me, great. The takeaway, this approach works, but it's not plug and play easy. It demands careful execution, sufficient capital, and respect for the process. The good news is, if you do all that, you can truly tilt the playing field in your favor in what is otherwise a tough game. Remember, only 5% pass when going in solo. Now, to lighten it up a bit and give you some perspective, let's look at a business analogy for what we're doing. And then I'll share some social proof, real payouts to show it's not just theory. Let's step back from the minutiae of trading and talk about this like a business. Why? Because framing it as a business can help you understand the mindset and the returns in a more familiar way. Imagine you wanted to start a small business, say a franchise coffee shop. You might invest, I don't know, like 50,000 or 100,000 to get it up and running. The business might net you maybe 50,000 a year in profit once it's established, just as an example. What we're doing with prop firms is not entirely different in concept. We are investing capital and effort to build an income-generating asset, our portfolio of funded accounts. Instead of a physical shop, our assets are these funded trading accounts. They don't cost as much as a shop upfront. We said 50, 60K to build towards 2 million allocation. And they can yield similar or better returns if managed well. 100K per year in our plan with the 2 million portfolio. Also, think about risk in business. A normal business's risk is that your 50K investment could fail. Maybe nobody comes to your coffee and you go bust, losing that 50K investment. In our prop firm approach, the hedging strategy is like buying business insurance. We accept losing a known amount, the hedge cost, to ensure the business succeeds, here the funded account. We are basically building a business with an upfront insurance premium that dramatically increases the chance of success. Traditional entrepreneurs might envy that if they understood it. In business, there is no way to guarantee customers will come. Here, we sort of can guarantee a funded account if we pay for enough hedge attempts. I also compare this to something like real estate. If you want to control a 1 million property portfolio but only have 50,000, you might leverage with mortgages, borrow money, etc. That introduces interest costs and risk of foreclosure if you can't pay. Our method is like leveraging to control 2 million of trading property using 50,000, and the cost of leverage is the challenge fees, like interest, and hedging costs, like insurance. If a property, the account, blows up due to a bad trade, we don't blow our whole personal capital. We just lose that one account and maybe some time. Then we rebuild using the process again. It's compartmentalized risk, similar to if one rental unit fails, you're not completely ruined if you have insurance and others running. All right, I hope that analogy makes it clear. We're acting like business owners or investors, not gamblers. This mentality shift is crucial. Instead of, I hope I pass this challenge and then YOLO trade big profits, it's I'm investing X amount of dollars to build a system of accounts that will pay Y dollars per month reliably. And indeed, when done right, it can be reliable. One more piece of proof is more of a macro view. The fact that prop firms have boomed into a 20 billion industry with so many participants, yet a very small percentage succeed, tells you that if you can crack the code, you're in an elite minority. And many of those who are consistently making money with prop firms are using strategies like we discuss quietly. I consider it a bit analogous to early days card counters in blackjack. The casinos, prop firms here, know some smart players might beat them, but as long as most people lose, the house is fine. We, of course, want to be the card counters, not the average gambler. So yes, this works. It's being done across more than 5 million FTMO accounts at Exo Capital, and it can be life-changing if approached correctly. But it's not for everyone, and not everyone will be comfortable with the effort or mindset required. That leads us to an important point: who should and shouldn't pursue this path? Before we talk about whether you specifically should do this, let's cement the understanding with a concrete case study style walkthrough. I'll use a middle-of-the-road example, building up to managing 3 funded accounts, each 200K, using our hedging strategy. 3 accounts totaling 600K isn't the full 2 million scenario, but it's a great milestone to aim for and illustrate the process. Once you can do 3, you can scale to 5, 10, etc. by repeating the same process with more capital. Phase 0, preparation. Let's say you have saved about $15,000 as your starting war chest for this project. You've chosen the best prop firm, FTMO, for a 200K challenge. The fee for that challenge is around $1,200. You decide to attempt to secure one funded account at first, then use its payout to finance additional accounts. So you allocate maybe $5,000 of your $15,000 to the first round of attempts. Phase 1, passing the first challenge phase. You will start with $2,000 on the broker side. So you have enough collateral to pass the 10% target on the account. Once you've burned all the collateral, you should have reached the 10% target, which is 20,000 for a 200K account. Now you have one 200K phase 1 passed. After that, you do the same thing for phase 2, taking note that the target will be 5%. We need the same collateral because we've lost some collateral at phase 1. So we need to have a higher hedging ratio to refund our loss in case we breach the challenge. Then it will be the first payout cycle when we enter the funded stages. When we are at those steps, we cautiously use the previous money we made from the previous phase in order for us to have some hedging collateral. I'm not entering in too much details here, but at the end of the video, you'll have a tutorial step-by-step to watch everything with a spreadsheet. Now, the third phase would be to scale up the accounts. We started just a 200K account, so you still have 10K on the side. You can start another 400K. Doing the same process, you'll get funded with those other 400K, totaling 600K total portfolio. This can yield you annually about $30,000, knowing each 200K will generate roughly 10K. So with those 30K generated the first year, you can compound again your profits to scale your total portfolio. This is how you enter in phase 4, which is managing a 2 million portfolio that can generate 100K per year. Once again, I'm not entering into details. I let you go watch the video detailing all the specifics and the parameters required, but stay until the video to know everything about that first. By walking this scenario, I hope you see the pieces tied together. Hedging to obtain accounts, disciplined trading to profit, then reinvesting profit to scale up more accounts. It's a rinse and repeat cycle. The first account is the hardest or takes the longest because you're paying out of pockets. Once you get some funded and profitable, the growth can accelerate using your gains. One more note. Some people ask, why not just keep trading one account and scale it up? Some firms offer scaling plans to increase account size over time. You could do this, but that usually requires leaving profits in and compounding, which ironically increases risk of losing it all on a bad run. By taking profits regularly and spawning new accounts, you're diversifying risk. Think of each funded account as a separate revenue stream. If one blows up, the others still produce. If you add one big account and it blows, you have zero. That's why I prefer multiple smaller accounts over one giant one, even if the total capital is the same. So that's the life cycle. Funding, payout, reinvest, more accounts, repeat. It's a sustainable loop as long as prop firms exist and are willing to keep selling challenges, which they are. Trust me, they love selling challenges. You might be thinking, this sounds like a lot of work. Is it for me? Perfect. Into our next section, let's candidly discuss who this strategy is best suited for and who might be better off not doing this. This approach is powerful, but it isn't for everyone. Let's break down the ideal candidate traits and those who might struggle or should avoid it. I want to save people from wasting time or money if this doesn't fit their situation or temperament. Who should consider this strategy? Serious committed traders or investors. If you view trading as a business and are willing to put in the effort to manage it, you're a good fit. This is for someone who isn't just looking for a weekend gamble, but actually ready to follow a plan meticulously over months and years. Maybe you've traded before, maybe you haven't, but you at least understand basics of markets and are serious about learning any execution skills needed. Those with sufficient risk capital, I'd say you should have at least several $1,000s you're prepared to allocate for this venture. Ideally, 5 digits amount. You don't need the full 50K upfront. We grow to that in our plan. But if $500 is all you have to your name, this path will be extremely tough. You'd be one of those one-shot Alices we discussed, which is not ideal. However, if you have, say, 5K and can add more over time from income, you could start small, maybe try getting a 50K funded account first, then scale up. The key is don't use money you can't afford. It should be risk capital like any business investment. People who value risk management over gambling would be our third point for the person who should consider this strategy. If the idea of guaranteeing a win by paying for a hedge appeals to you more than I'd rather just try to trade one account and maybe hit it big, then you have the right mindset. Our strategy is about controlling risk, not maximizing thrill. You might be someone who is actually a decent trader but kept failing challenges due to one or two mistakes. This structure could be perfect to get you over the hump consistently. Disciplined and organized individuals. Are you able to follow rules, keep records, and stick to a system? If yes, you'll do well. The process requires discipline, cutting off a winning account at a planned profit instead of getting greedy, or systematically executing the hedge even when one account is tanking, resisting the urge to deviate. If you're organized, managing multiple accounts is feasible. If you're scatterbrained or impulsive, it could be messy. Of course, for the done-for-you solution, everything is handled for you, so you just need to fully understand what we are doing, since we don't want, like I mentioned previously, someone that is not aware. Next point will be those seeking consistent supplemental income. Maybe you have a job or another business and you're looking for a methodical way to add, say, 5K, 10K a month to your income after some ramp up. This strategy can serve that goal. It can eventually become fully passive if you're working with a management service like XO Capital. Some of our clients treat it like a business they invested in. Our last point would be traders or investors open to collaboration or using services. If you acknowledge, hey, maybe I want help with this, like using a firm such as XO Capital, then you're likely to succeed because you'll leverage existing expertise. You still should understand the process, but you don't have to do it completely alone. The ones who do well sometimes are those who treat it as an investment and let a specialized team handle the heavy lifting for a performance fee typically. If you're that type, it can work beautifully as your incentives align. We only make money when you make money in our model, for example, that is based on profit splits. Now, let's talk about who should not do this. Get rich quick seekers. If you're drawn to this because you think it's an overnight riches scheme, this will disappoint you. Yes, the ROI can be high, but it's not instant and it's not without effort. There's no magic button here. It's a systematic grind. If you have an almost addictive mindset looking for the next big score, you might end up cutting corners, like not hedging properly to save on fees, then failing challenges, etc., or over-leveraging once funded. Those behaviors will sabotage the plan. This strategy is anti-hype. It's relatively slow and steady in trading terms. Even though making six figures in a year might sound fast, it's done in a measured way. Second point would be people with zero tolerance for loss. Ironically, some folks can't stand the idea of intentionally losing one account to win another. It feels wasteful to them. If you emotionally cannot handle paying for something that fails, even by design, this will mess with your head. You have to be okay seeing red on one screen and green on the other and understanding that's part of the process. If you're the type who'd freak out and try to save the losing account or otherwise break the hedge, you could end up failing both. So you need the ability to incur planned losses calmly. If you can't, then a one account trade approach or maybe trading your own money might actually be better. But then you accept the much lower odds. Next, underfunded or financially precarious individuals. I touch on this, but it's important. If scrapping together a few $100 is a huge deal for you, do not do this yet. Work on increasing your savings or income first. The pressure of this $300 must turn into rent money will cause you to panic or make bad choices. Also, even though this is safer than outright trading your whole account, there is still a chance you use up your small capital with nothing to show if you hit some bad luck or mistakes early on. I don't want someone going into debt or not being able to pay bills because they attempted a prop firm run. So get your financial baseline secure, then attend this with money you classify mentally as an investment in your education or future. Next point will be those unwilling to learn or adapt. If you thought this was just buy a secret software and money flows, and you're not actually interested in learning trading basics or how to manage accounts, you might flop. While you don't need to be a master trader, you can be completely hands-off, brain-off. You need at least to understand the process we are doing. You should either be willing to learn the ropes or partner with someone who knows them. If you find all this talk of challenges, drawdowns, hedging confusing, and aren't keen to educate yourself more, then you might get stripped up in the execution. Now, none of these are written in stone. People can change habits, and you might find that having a structure helps you become more disciplined. But it's important to evaluate where you stand. One more note. If you're already a highly profitable trader with large personal capital, you might wonder if prop firms are even worth it for you. Some such traders still use prop firms to diversify and trade other people's money, OPM, because why not? It can boost returns with limited downside. But if you truly can make 100% a year on your own 100K consistently with acceptable risk, you might just do that and not bother with profit splits or these constraints. For many, though, the prop route is appealing because even a great trader might not have a million of their own to trade, and this opens that door. All right, by now you should have a good sense of whether this path aligns with you. We've covered a ton of ground. In the final section, let's recap the key points, and then I'll point you to further resources and the video I've mentioned previously. We've just gone through an in-depth exploration of leveraging prop firms with a hedge-based strategy. Let's quickly summarize the journey. We started by laying out the vision, accessing 6 to 7 figure trading capital with limited personal funds. The goal? Consistent returns, not hype. We pulled back the curtain on prop firms' business model. Remember, most of them make money from your fees, not your trading success. In fact, they rely on the majority failing challenges. You manage demo accounts, and payouts are essentially paid from the pool of failed fees. Only a small elite percentage of traders ever see a payout. This knowledge isn't meant to discourage. It's to motivate a smarter approach, because we don't want to be the 90% feeding the system. We want to be the 5–10% who beat it. We compared the situations of a $300 budget newbie, a $100K capital trader, and a $1 million oriented investor. The takeaway: with tiny capital, your odds are slim unless you get lucky. With moderate capital, you can significantly bend the odds by investing in multiple attempts, and with a larger plan, you can build a casino trading business akin to a fund. It highlighted why treating this like a business and not a lottery is crucial. We laid out concrete numbers for a full-scale plan. We demystified the hedging strategy. Using 2 accounts with opposite trades to guarantee one winner is the core concept. It's basically buying insurance on the challenge. We discussed how one account hitting profit while the other is loss is by design, and that losing a fee or 2 is acceptable to ensure a pass. We also cautioned that prop firms don't love this. It's often against their terms to hedge between accounts, so it must be done carefully to avoid detection. The hedge turns the challenge process from a gamble into more of a calculated expense. We didn't shy away from the downsides. We talked about the risk of getting banned if sloppy, the need for enough capital and patience, the complexity of managing multiple accounts, and the discipline required. We stressed that it's not a magic bullet, it demands work and adaptability. Also, not all firms are trustworthy. You stick with reputable ones, essentially FTMO. It works, but don't underestimate the effort. We walked through a concrete scenario of going from challenge funded to payout and reinvest stages. These gave a taste of the process and timeline, showing that within maybe several months, you could be managing multiple accounts if it all goes to plan. Finally, we profiled the ideal and not so ideal candidates for this approach. If you're disciplined, have some capital, treat it like a business, and desire consistent gains, this could be a great path. If you're looking for a quick thrill, have no money to spare, or hate sticking to rules, this likely isn't for you. The strategy favors those who are patient and methodical. Throughout the video, I've kept the tone honest and practical. This isn't about hype. It's about what's realistically achievable if you put in the capital and stay smart. The truth is, prop firm trading can be transformative, but it's not easy money. It's smart money if done right. Now, as a soft call to action, I'm not going to push any hard sell or anything. I genuinely want you to succeed, whether you do it on your own or looking for help. If you found this valuable and want to delve deeper into the actual mechanics of hedging strategy, like a step-by-step on executing those opposite trades and ensuring you don't lose money in challenges, I have the perfect next resource for you. If you want to see exactly how to profit from prop firms using a hedging strategy, check out our top video, How to Make 10K with Prop Firms and Hedging Strategy.